paper is a great paper. This financial management already with you, financial management already with you. I've been able to do topic number 1, topic number 2 complete. Now I'm doing with you topic number 3. This particular class, I've been able to do with you the first 2 topics exhaustively. So today we are doing topic number 3, financial institutions and markets, overview of a financial system, financial markets, financial institutions, and financial instruments. 3.2, they want us to look at nature and role of financial markets, both the primary and the secondary securities market, money market and the capital markets, over-the-counter and organized market, derivatives market, mortgage market, forex market. Then they want us to look at 3.3, Nairobi Securities Exchange, NSE or equivalent entity in other jurisdictions, the role and the functions of the securities exchange terminologies, security exchange listing, and the cross-border listing, share indices, timing of investment at the securities exchange, central depository system, and automated trading system. And then most importantly, we have the concept of demutualization. Like now we know that NSE was demutualized like 5 years ago. They want us to look at stock market indices. Again, we come and cover this electronic wallet of putting in shares, what we call the central depository system and the automated trading system. Timing of investment at the securities exchange, the Dow theory and the Hatch system of timing, very, very important. 3.7. The financial institutions and intermediaries, commercial banks, savings and loans associations, and the cooperative societies, foreign exchange bureaus, unit trusts, and mutual funds, insurance companies and pension firms, insurance agencies and brokerage firms, investment companies, investment banks, and stock brokerage firms, microfinance institutions, and SMEs. Regulation of financial markets, Central Bank of Kenya, or equivalent entity in other jurisdictions, the role of the central bank and the monetary policy of the central bank, capital market authority and insurance regulatory authority, factors responsible for the rapid development of financial institutions and markets, risks facing financial institutions, like some banks. Look at, for example, First Community Bank. I mean, it really right now is in a big problem. So I've been able to read to you what I will be doing tonight in terms of financial management, topic number 3 from your course syllabus, course outline. And then now what I like doing, before I start looking at the topic, I would want us to look at a few questions on this topic from the past papers. Yeah, a few questions from your past papers. They will act like our pointers, all right? So as I read the handout with yourselves, you'll be able to see, I mean, this is an examinable area, this quite new, something like that. So with your permission, I'll be able to read this handout that I've been able to send to you. A few minutes ago, I've sent to you some handout, of which I would want you to go to page number 12, no, page number 11, page number 11 of your handout, page number 11 of your handout. Are we there? Page number 11 of your handout. Yeah, please, somebody should be able to help Mwalimu by sharing this handout in your WhatsApp group, Okay, so we shall discuss about those videos which are not. Let's enjoy the moment now, Sarah. Let's enjoy the moment. All of us now, we are in this topic. Forget about all those things here. We shall be able to discuss them at the end of the session. That is how the Chief Ninja is guiding all of us. Let's, in this case, here seize this opportunity to just understand everything that is in this handout, because we shall get a question. We shall get a question out of this. So I would want us straight away to go to December 2024, question number 4B. Somebody, December 2024, question number 4, boy. December 2024, December 2024. Is there somebody who has already been able to get this question? December 2024, question number 4, boy. For those of you who already have our revision kits, for those of you who have our revision kits, For those of you who have our revision kits, I would want you to go to page number, yeah. For those of you who have our revision kits, yeah. For those of you who have got our revision kits, RCM's revision kits, you simply go to page number 17. Page number 17. Or if you don't have them, you can simply go to your past papers, December 2024, question number 4B. Is there somebody who has already gotten that question? December 2024, December 2024, question 4B. Is there somebody who has gotten that question already? Yeah, December 2024, question 4B. Thank you so much. So we are reading this now together. We are told financial institutions often employ risk management strategies and adhere to regulatory requirements to mitigate these risks and ensure stability in their operations. Financial institutions like banks. However, the dynamic nature of the financial industry requires ongoing monitoring and adaptation to emerging risks. Good question. In relation to the above statement, they want us to describe 6 types of risks facing financial institutions in your country, in Kenya here. So is there somebody who can talk to me regarding types of risks facing our financial institution? Remember, risk stands for danger. You know, when you see banks in this case here doing the big business outside here, they're making profits, there are a lot of danger zones. There are a lot of risks in this case here that are beckoning, all right, which may easily make these banks in this case here collapse. So what are some of these great risks that in this case here may easily affect, yeah. So, yeah, so I can see you guys already know. Thank you so much. Thank you so much. So then I'll be able to read the answer here pretty fast. I'll be able to read the answers here pretty fast, and I'll be able to, like credit risk. The risk that borrowers may fail to repay loans you have given out your money to so many people outside there, and then they fail to pay. Ladies and gentlemen, remember, over 80% of individuals outside here go to a bank to borrow loans without any intention of paying back. It's called credit risk. That one has wiped off so many banks out of business. Look at Chase Bank. Credit risk, that you're going to give people money and then you start, in this case here, calling people all over. Like remember, we had so many of these online lending apps. Were they Tala? Do you know others were able to go under the sun? They were buried even before they celebrated their first birthday, simply because of what here? Credit risk. Credit risk. You guys shall be able to help me to answer some of the questions. Please help me answer some of the questions. And then the most important thing that you need to do for me is to go to WhatsApp and tell those students who are on WhatsApp that today it is this Chief Ninja who is teaching what here? FM. Because I can see guys are asking about David. Today it's me who is here. Yeah, so that we can minimize asking so many questions here for Mwalimu to be able to cover lots of ground. Within 1 hour, we should be out of this place. Within 1 hour, we should be out of this place if we can just avoid so many questions. And you can only avoid those many questions if someone like a class rep can go to the WhatsApp group and say, today, it is Dr. Joshua Aura who is teaching us FM. Yeah, so when you see him, don't think that you are in a wrong class. Yeah, so that we shall overcome, right? We shall overcome. All right. Now that you guys had mentioned these risks, I will be able to read them very fast. We have what we call market risk. The risk of financial loss due to changes in market conditions. All right. The macroeconomic factors, including fluctuations in interest rates, exchange rates, stock prices. For example, banks that hold bonds will lose money if interest rates do what here? Rise. Ladies and gentlemen, remember market risk. You guys must be very good. In economics, we have what we call micro, and then we have macro factors. Those external factors, all right? So like currently what is happening? The other day, I was at Central Bank of Kenya, trying to buy some treasury bills. And then I was told, hey, this is not the time to buy these T-bills. Why? Because like the 3-month T-bill is now going for 9.92%, all the way from 18%. So when the treasury bills come down, you as a bank will automatically be required to do what? To reduce your interest rate. Why will that happen? Because you will not be having, when the rate is so high, when the treasury bill rate, when the bonds from government are giving so high rates, what happens? Banks will always go for government. They always give money government. When they give money government, it means that the SMEs will not be having anything. And the demand from SMEs will keep on rising, demand for money. So then what will happen is that interest rate will go up. But when the government bonds, in this case here, rate come down, whenever they come down, then automatically the banks will not now be willing to give the government money. So we'll be having oversupply of cash. Those are the macroeconomic factors you're talking about, the inflation, things like that. So when those rates come down, there are chances that the bank could be in danger. The bank could be in danger here. So we have your market risk. Then we have operational risk. So operations, remember operations, you're looking at what here, your systems as a bank. If your systems in this case here collapse, then people will be able to still, you can imagine if something crazy was to happen today and the people hack onto M-Pesa, if people were to hack onto M-Pesa, if there was an operational failure, internal control failure in M-Pesa, if people were to hack this M-Pesa like now tonight, I'm so sure by tomorrow morning, Safaricom will not be having anything in their biggest wallet. People will steal. So operational risks could be risks emanating from employees. Employees would want to steal everything from these companies. All right. Operational risk. Very, very important for you to know that. So here we are basically looking at those dangers that can knock down a bank. So operational risk, the risk arising from failed internal processes, systems, or external events, such as fraud, cyber attacks, or even natural disasters. Financial institutions must ensure their operational infrastructure is secure and efficient. Then we have number 4, liquidity risk. The risk that a financial institution may not be able to meet its short-term financial obligations due to inability to convert assets into cash without incurring significant losses. Ladies and gentlemen, if you normally read the business daily every other day, like so many banks right now are crying for what? That there is no money, enough money circulating in the economy. Yeah. Many SMEs are closing shop every now and then. If you get business daily today or even Daily Nation today, go to the auctioneers pages. The auctioneers pages in this case here are awash with advertisements of banks wanting to sell what your assets, and nobody's interested in those assets even at a quarter price. So when companies like banks are holding on to many, many assets, they would want in this case here to sell them and they're not able to sell them. So they become illiquid. Whenever you lack liquidity is this excess water that you have. This excess water on the corridors that you can even at times, in this case, even I'm like myself, you can easily even slide on top of your floor. Things are moving in a company when everything is liquid. At times, in this case, that liquid may not be there. You have assets that you cannot sell. And that is why some of us, like what I do, I'm very, very prudent as one of the investors of RCM. One of the investors of RCM, we know that liquidity is the king. We know that liquidity is what here? Liquidity is the king, is the king. So what we do, and you have seen colleges that have made a mistake out of this. So you'll get, for example, currently RCM, we have about, stroke of 4,000 students now. Numbers have really doubled. God must be looking on our way this time around. If you look at, for example, financial management in the evening, you're over 300 students. All right, very good. Now, chances are, if, for example, we're to get, say, like 40 million Kenya shillings in a term, we may be under deception to start investing this money in land. What do you know about land? I know you guys are mature enough. If you buy land, you go buy land, for example, in Kajiado, say land, or even Nairobi, yeah, Rongai, etc., land worth 20 million. Do you think in the future it will be very easy for you to sell that land? Will it be very easy for you to sell that land? No. Because in this case here, there is no liquidity in the market. All right. So it means that even RCM will become illiquid. And that is why what we normally do whenever we have some excess cash, we now start looking at what we shall be studying today, the concept of money markets. Right? Get some, for example, this, if we had the money, how I wish we had that money, get some like 8 million, put this in CIC. CIC today, their money market fund is giving 12.13%. That's CIC money market fund. What is the advantage of money market fund? Money market fund, if I want my money today, I'll simply go to CIC app and then I say withdraw. Maximum 4 days, I have my money. Between 2 to 4 days, I have my money. That is the concept of what here money market fund. It's a short-term investment vehicle that you can easily use, ladies and gentlemen, to ensure that all the time you're watching your lead. So even banks, because banks, whenever customers, in this case here, whenever customers charge properties, whenever customers charge their properties for purpose of taking a loan and then they default, the banks take those lands, they take those properties, but now they are not able to sell. So there is a liquidity risk that these banks can get into what we call a cash crunch. A cash crunch. It's called liquidity risk. All right. Then we have, ladies and gentlemen, like regulatory risks here. From the regulators, we have, for example, if it's banks, ladies and gentlemen, we have in this case here the banking regulator. So you are not able, so the regulatory framework surrounding derivatives, am I reading something different? Yeah. Most important, ladies and gentlemen, when we talk of regulatory and legal risks, we know that banks and any financial institutions here, they work under strict supervision. There is a risk that your license can be revoked. If it is revoked, that is so dangerous to you. You shall run out of business. Legal risks, for example, you are not following KRA laws. You're not paying your taxes. You are running, for example, 2 payrolls. When KRA will come and catch you, they will lock your account. Those are the kind of risks you are looking at. The kind of risks you are looking at. So we have here market risk. Market risk. Of course, market risk, ladies and gentlemen, market risk here. So we have here, although derivatives are often used to hedge risk, they are still exposed to market risk. The risk that the market will move unfavorably. The market will move against you. The market will move against you. Now, ladies and gentlemen, we have so many risks affecting banks, insurance companies. And I'm happy because you are able to list most of them down. So as I go to a different question, can you kindly just name 3, only 3 risks that face banks in Kenya? Only 3. The ones that you can never forget. Only 3. Only 3. Only 3. Yeah, thank you, Dave, for mentioning Etika and Saiton. I can't invest in them. I can't invest in them totally. I know the returns are still upwards of 20, but I know the higher the risk, the higher the return. I don't want to risk school fees belonging to students. Liquidity, market risks, credit risks, operational risk, inflation. Great. No, you cannot have like fraudulent customers as a risk. No, you know, those risks are very, very specific. You must write their names like that. You must write their names like regulatory risk, legal risks. You can even separate them. Yeah, market risk. Market risk is a risk that all the metrics may go against you, and then you get yourself, in this case here, just coming down. Thank you so much for the participation. And with your permission, then I'll be able to go to question number 2. So question number 2, I would want you to open your past papers and look at August 2022, question number 3A. I don't think I'm reading the correct paper. Let me just get your paper here. I don't think I'm reading the correct paper. August 2024. Yeah, August 2024. Question number 2. August 2024. Question number 2A. Let me know once you guys are able to get this question paper. August 2024. August 2024. Yeah, August 2024. Question number 2A. Once you're able to get this question, are you able to put your thumbs up? Are you able to put your thumbs up? August 2024. Question number 2A. August 2024. Question number 2A. Question number 2A. Thank you so much. Somebody can even share this paper here. For those of us who have this revision kit, we are going to page number 17. And you need to buy this revision kit. They go for only Kenya shillings 1,000. Kenya shillings 1,000. So August 2024, question number 2A. Describe 3 types of money market instruments and their related transactions available in the financial system. I've marked financial management for so long, over 25 years. And it's one of those papers that are normally done so poorly in the entire country. And it's not because we are teaching stupid students. No. The students are normally very bright, but they normally ignore theory areas. And if you're keen enough, you realize that your theories normally cover between 28% and 32% of the entire paper. So normally what I do, I ensure that my students are able to get that, all those marks, like if it's 32 like that. And do you know what? Never be cheated by anybody. Your pass mark does not hit 50 exactly. People will tell you it hits 50, but there is something they normally do to push them up. Yeah. So what I know, if you just go to an FM exam and get 32%, 2%, it doesn't matter whether you're doing theories or what. Just get 2%, you will pass that paper. You'll pass that paper. Yeah, and I normally tell students, my students hear the truth. If you get yourself failing like in this paper like that, chances are you normally get like 0. Because I mean, we try like last semester. I mean, we try, push you guys up. But again, you get yourself doing what you're fair. It's because you have never taken keen interest with the theories. I may sound a little bit rude, but it's good I tell you the truth because you are my sons. You are my daughters. Yeah, you'll get everybody's just about discounting, NPV, replacement. They are doing in this case here, for example, present value, everything like that. But they forget theories. The examiner will never twist you in the theories. The examiner will always give you straightforward theory questions. Yeah. You think I'm cheating? Yeah, I've marked. I'm telling you the truth. This is a paper if you guys decide, like now you are about 300 and something in the evening. If you decide, all of you will pass. All of you will pass. But normally, like now, look at what was happening last week. I tell you guys, let's meet over lunch hour, we do some theories. And then guys are making lots of noise. Instead of you guys clapping for me, you say, Mwalimu, we paid for 3 sessions, but now we are learning even 5 times. Now you'll get people even getting to my inbox and telling me, you chief ninja, we don't want extra classes. It has to be as per the timetable. Na mimi nasema namna hii, exam ikija, piga mwalimu woi. And you know, at times, ladies and gentlemen, the way we set these papers really is to scare you. Yeah, like question 1, I can easily make question 1 look like home science. Yeah, some student reads here, Shanga, is this home science or even geography? I mean, it doesn't come like a financial management question. That's question 1. Question 2, physics. You know, there is a way we do this thing in a way that, for example, if you are a lady who goes with very good makeup to an exam, there is a way we set these papers that after 30 minutes, you simply turn back the examiner's script. And then you just start going out. That makeup, everything has disappeared because you've been crying over doing that exam for that 30 minutes. And now the most uncomfortable thing is that if you have, for example, some high-heeled shoes, you may not even be able to walk on them very well. And that is why I would want you guys to create time for the theories. We need to do all the theory questions, for the last 10 sittings. Yeah. So are we in agreement, first of all, before I continue, that we shall be able to handle some sessions of a lunch hour to touch on theories? Are we in agreement? Or would you rather, in this case, you get out of an exam and you're not able even to walk on your high shoes even for a kilometer to your vehicle? You even start, in this case, you're not walking just barefoot. You know, these exams at times, is there anybody, let's be very honest here, is there anybody who has ever been harassed by CASNEP exam? Is there anybody who has been ever, like seriously? It's, we don't want we don't want to get ourselves in this kind of a situation. You'd rather, in this case here, look at this other softer way. I mean, it's quite tough. I know you guys are working, you guys are busy, you are people's wives, you are people's husbands, I know. But I mean, you just create more time here. We suffer a little bit. After all, it's only for 2 months. It's only for 2 months. So you can see now people have stories here, good stories here. All right, which days I'll be able to come. I'll be able to come back to you regarding that. Regarding that. Now, ladies and gentlemen, let's come back to this question. Let's come back to this question. So here they wanted us to give them types of money market instruments and related transactions available in the financial system. So whenever, for example, banks have some surplus monies that they can lend, for example, to companies out there, governments outside there, say for 2 weeks, less than a year. What are some of the investment vehicles that are available to them? Remember, there are 2 ways using this extra money. It is either to lend it out there short term. Short term means money markets, yeah, less than 12 months. Or you go long term, bonds, etc. So this question is very specific, and there are very few students who can get this question correctly. Very few students, and I'm so sure you guys are geniuses. You'll be able. So types of money market instruments and related transactions available in the financial system. Financial system means like banks. So we have here treasury bills, the T-bills, short-term government securities issued at a discount to face value. They are sold through auctions and they can be bought by financial institutions or individual investors. T-bills are typically used to raise short-term capital for government what year funding. So in this particular case, if we have Equity Bank seeing themselves having surplus, you shall never have surplus money, even on your phones. I hope it's being recorded. Yes, it is being recorded. Yes. Whenever you have some surplus money, even on your phones, you need to open what we call a money market fund. How many of us in this case here happens to be having some money market fund accounts? Do we have MMFs, money market funds? And which banks, which apps, Wycliffe, which one do you have? Which one do you have? Mali is the one that is collapsing? Or Mali is the better? ZD is the better one, isn't it? Etika, Sanlam, CIC. I'm also a member of CIC. All right. Sanlam, very, very good. Lofty Coban, very, very good. Okay. Etika. So we shall be able to discuss with yourselves, and you shall be able to tell me, why did you, for example, choose Nabu? Yeah. Why did you go for Zimele? Yeah. Like Zimele, it's known for what year? They have a very, very good application. The online application is among the best. So you'll be able to discuss something around that. So even these banks, ladies and gentlemen, they have we shall overcome. Even banks, they have their ways of investing their surpluses. And one of these is to go and buy treasury bills. So they buy the bills, they give government money. All right. And remember, bills are normally sold through what year auction? Auctions. All right. So we'll be able to discuss about that. But whenever you hear money markets, in this case here for banks, always remember T-bills, treasury bills. That's very, very important. Number 2, remember what we call the repos, repurchase agreements. Repurchase agreements, short-term borrowing and lending arrangements, where one bank sells some securities to another with an agreement to repurchase them at a later date. This allows financial institutions to manage their short-term year liquidity. So in this case here, they have, ladies and gentlemen, what is happening here under repos. You must have heard of repos. It is quite there in these banks. So you get in this case here, one bank has got a deficit in terms of money, another one has got what? Yes, sir? Surplus. So whenever there are repos, ladies and gentlemen, we shall agree. So I tell you in this case here, this is Equity Bank telling Barclays Bank that you know what? We have in this case here, this, please take up this cash. So you are given in this case here like a small commercial paper. Yeah, you're buying a commercial paper. Yeah. Yeah, you are given in this case here some so you and a repos. So we are giving you this paper. Please just have this paper. Give me money in return. So they give you like 10 million, and then later on in this case you shall be able to repurchase this either at a profit or at a loss in your side, because these particular repos they trade. They have their own value. So they are simply like small bonds. So I'm giving you like a bond. I'm bonding you. I'm giving you a bond. You're giving me money. Then in the future, I'll be able to repurchase back the bond and return your what here? Return your money. Return your money. All right. So David J, I'll come back to this, Dell. It's my responsibility to teach you guys how to do this MMF. I'll be able to teach you all that. Let's first of all finish. That's why I said this class is only a class for 1 hour. And then I'll have another 1 hour to show you guys how to invest, how you'll become also chief ninjas in terms of money very, very soon. For now, we want to understand everything here. So whenever they talk of money markets, remember treasury bills, and then remember these repos arrangements. Short-term borrowing and lending, where one party sells securities, could be shares, whatever, or to another with an agreement to repurchase them at a later date. Certificates of deposits. I mean, these are very, very common, and I'm so sure there must be somebody here who has a certificate of deposit with a bank. There must be somebody here with a CD with a bank. Do we have anybody who has a CD with a bank? A certificate of deposit where you go and deposit some like 1 million with them, and then they give you a certificate? Yeah, Sarah, I'll come back to that. Sarah, I don't want you to discuss about CIC now. Now you're discussing something different. I'll come back to that. Yeah, so you can see admin already has a certificate of what the deposit. Also, banks have the same. They simply, if it's Equity Bank, they go and deposit their monies in ABSA. So like for 1 year, that makes it what? Short term. Yeah, certificate of deposit. It's a form of what year? Money market fund. Certificate of deposits. So certificate of deposits, time deposits, issued by banks that offer higher interest rates than regular savings accounts. Remember, in most cases, savings accounts will always earn you 0 interest actually in 100% of these banks. But if you go and fix these and you get what we call a certificate of deposit, then you'll be able to do what here to get this good interest on top. And then we have interbank money market. Interbank money market is very, very popular, ladies and gentlemen. How does there are people who are very, very bright in this world. There are people who are very, very bright in this world. There are people who normally do overnight lending and overnight borrowing. Just overnight. Like now here we are here studying FM, and there is a small ninja that has borrowed money for just 12 hours. When the bank closes, he borrows like 1 billion Kenya shillings. He does his abracadabra at night. I don't know what they do. And then in the morning, and they never delay. In the morning, they return back that money plus interest. How is that just? How is it now? Sorry for that. Is it okay now? Are you able to hear Mwalimu? Nice now. Okay, great. Thank you very much. So, ladies and gentlemen, there are those people who are very, very bright. They are prudent financial managers. They borrow overnight. Oh, they normally do wash. Nuria is saying that these guys, they normally do wash. Must be a night run. That business. Okay. Okay. So normally also banks, in terms of money markets, we have here interbank money market. Banks use this to borrow overnight or for a maximum of 2 weeks from each other. Why do banks borrow from each other overnight? Because remember, banks normally have minimum cash requirements. Like whenever they are closing their day, there is some amount of money that they must, in this case here, be having back in their branches. So when you realize that you have some shortage, what do? You do an overnight lending or a fortnight lending like that. And of course, there are also other ninjas now who can easily borrow and then they do this crypto, etc. So ladies and gentlemen, please, whenever they talk about money markets in banks, what will you always remember? What will you always remember whenever they talk of types of money market instruments? Money market instruments, money market instruments in banks. What will you always remember? Money market instruments, treasury bills. I love that. Repos, number 2, certificate of deposit, the CDs, yes. CDs, yes. Interbank lending. Interbank lending, very, very important. Don't forget that. If Kasneb was to give me, the repurchase, very, very good. If Kasneb was to give this old ninja a chance to set a question, you will see that question. Short term, yes. You will see that question in your exam. Now, ladies and gentlemen, please allow myself here to take you to another question, which is April 2024. Question number 1 being, April 2024, question number 1B. April 2024, question number 1. Boy. April 2024, question number 1. Boy. Once you get it, can you kindly put your thumbs up? Once you get it, kindly put your thumbs up. April 2024, question number 1. Boy. All right, thank you so much. So if we read this together, what were they talking about here? Highlight 6 functions of financial intermediaries in an economy. In an economy. You know, financial intermediaries, we have in this case here, borrowers. Borrowers. And we have in this case here, investors who have excess cash. And then we have a bank in between. So investors who have excess cash, they're able to come and put their money in a bank. And then the borrowers are able. So when they talk of financial intermediaries, always think about what here, banks, think about insurance, what here, companies, etc. So then just argue out your case. What are the major functions of a great bank? Is there somebody who can give me those functions here? Let's see whatever you guys have here. You know, there are people who are normally, lending. Actually, that is the biggest thing. Before you go to risk reduction, these guys also have something to do with what here? Savings and investments. So they give us an opportunity to save. Savings. So savings and investments. Great. And then I can talk about risk reduction. Because remember, risk reduction, how does this risk reduction come about? The risk reduction comes about, we are many of us, we are many of us who are going to put this money in equity, and equity has brought in experts. Manage this money, invest on our behalf. The concept of, I was almost saying carpooling, cash pooling. So you're pooling resources together, which now we can easily use to penetrate any kind of what your markets. If I was alone and I was creating a circulation of money, okay. Then you can read my answers, right? Let's read our answers together here. So facilitate savings and investments. Financial intermediaries help mobilize savings from individuals and direct them towards productive investments, promoting economic growth. Risk pooling and risk diversification. They pool funds from multiple investors and diversify them across various assets to minimize risk, reducing individual exposure to financial losses. Providing liquidity, yes. Financial intermediaries provide liquidity by allowing depositors and investors to convert their investments into cash quickly whenever needed. Efficient allocation of capital. They allocate capital to productive sectors of the economy, ensuring that resources are used where they can generate the highest returns. Providing credit, financial intermediaries lend money to businesses and consumers, supporting economic activities and facilitating consumption and investment. Improving market efficiency by acting as middlemen. Financial intermediaries improve the efficiency of financial markets by reducing transaction costs and information asymmetry. You can imagine if banks were not there. We'll be talking of market inefficiencies. We'll be talking of you now moving from point A, looking in this case for some great wealthy man. I mean, it would have been chaotic. The transaction cost here would have been very, very high. All right. All right. So, but the most important things that you should never forget, and you can take this as separate points, ladies and gentlemen, that you shall never forget. Whenever you hear of functions of an intermediary, financial intermediary, we have savings. Yeah. So we give you an opportunity to save. There are very, very few people who save, especially this Nairobi of ours, very, very few people who save. I was quite lucky from a very young age. I got somebody who introduced me to Mwasibu Sacco, and those people that we started working with, we were very aggressively competing amongst ourselves, in this case here, to save at Mwasibu Sacco. And by doing that, by age 27, I'd already built my greater house, age 27. Courtesy of what year? Mwasibu Sacco. All right. But again, remember during those times, I think we were a little bit lucky. We were a little bit lucky because what we used to do, ladies and gentlemen, in those times, we used to put standing orders. So money comes, in this case here, your salary comes to your bank, and then you put a standing order, that money to go to Mwasi. You see now, a bank is enabling you to save because, ladies and gentlemen, the moment this money hits your pocket, is it easy to really save money once money comes to your pocket? Is it easy? Is it easy? Never, never, never. You may even be very, very good in terms of saving yourself, but there is always a spirit out here. Once you get like 100 G's in your pocket, everybody, including your grandmother, you start receiving calls. You start receiving calls. Yeah, at times in this case, even your children start getting some funny diseases, which they would not have gotten if you never had money. Within no shot, the spirit of Jezebel. So within no time, you don't have that money with you. So one thing that I know, ladies and gentlemen, savings normally it's not many. It's not many. Like I gave you this story that time when I was teaching you this theory class. I mean, whenever these students of mine pass exams, they normally call me somewhere for a soda, nyamachoma. Many of them, yeah, many of them, they'll call me. They tell me, Mwalimu, come here. But now there are those ones who don't know that this Mwalimu has got some little status. So they do, they call me to Quavers. So one time I went to Quavers, and that time Quavers was very new. I mean, I went there and I was really surprised. The investment was huge. It doesn't look like how it looks now. It wasn't looking like how it looks nowadays. That time is, I mean, so I was there. And then now we're taking our soda there. Come on, I'm not here. And then all of a sudden, I heard in this case here, the DJ mentioning the name of my friend. And it's like everything came to a standstill. Now, this guy was receiving a lot of what here. I mean, all people are looking at our table. From nowhere, I just saw some like 7 ladies marching to our side. They were carrying a placard like this, waving a very expensive drink. And now every music there stopped when the bottle was on our seat like that, on our table like that. So then later on, I came to learn that this guy had bought one of the most expensive. So when in this case it came to paying bill, this guy paid close to 60,000. So I took this guy as aside later, told him, you are financially illiterate. You are financially illiterate. That's what I told him. And that's what I will tell you. Even you, when you call me somewhere and you're spending more than even 4,000, then automatically you are financially illiterate. Yeah, you're financially illiterate. Yeah. Because we know what we call time value of money. If you go and invest this money today in Mwasibu, if, for example, it's Mwasibu Sacco, that same money, in this case, if you are doing a mortgage with them, you'll get 8 times. So when you pay 60,000, it's not 60,000 that you have paid. I mean, the opportunity cost is very, very, very high. Very, very high. Very, very high. The opportunity cost is very, very, very high. Yeah. Yeah. So they're telling me, Mwalimu, YOLO, young forever or what? What does this mean now? I can't be able to connect this. You live only once, eh? Is that no, 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 no. Those are not my finance students. My finance students, they shall be able to know that you save your cash today, and then that cash will save you tomorrow. This cash will save you tomorrow. This cash will save you tomorrow. Save it today. It shall save you tomorrow. Yeah, Veronica, I agree. Once in a while. Once in a while, but if you are a young man, please, I can tell you, everything is being set against us men. Everything outside here is being set against us men. We have to be very, very careful. And I told you even the other time, sorry for digressing a little bit, you'll go to some clubs here in Kilimani. You even get like they're bringing girls from out there. They're not even Kenyan. So look at the height of a lady. Before you realize, you look at your money looks at you. And then at the end of the day, you get like you have nothing. So, so you have to be very, very careful. You have to be very, very careful. You have to be very, very careful. We shall overcome. Must be a very good friend, Philip. Okay. We shall we shall overcome. We shall overcome. We shall overcome. We shall overcome. All right. So don't forget the concept of savings. Then we have investments with banks, very, very important. Don't forget the concept of what here, you getting a loan, credit facilities. All right. Ladies and gentlemen, also these banks can, of course, credit facilities. You'll be able to get your assets like that. All right. And then we have the concept of the market efficiency hypothesis. Very good points here. The last question is this one here that was set on December 2023, question number 3A. Question number 3A. Question number 3A. Let's get to this December 2023, question number 3A. Question number 3A. Is there somebody who has been able to get that question? Life today is better than life tomorrow. We shall overcome. We shall overcome. Yeah, and that's why you need to hang around, because after I finish this, I'll be able to give you a free of charge 1 hour class. 1 hour class just to discuss about investments. Today, we have to discuss about investments. We have to discuss about investments. They have gotten the question. Thank you so much. Thank you so much. So then we have the question here. Yeah. Yeah. So they want us to outline 5 eligibility requirements for public offering of shares and listing at the securities exchange in your country. Yeah. Yeah. So for you to be eligible to list at the stock exchange, NSE, what do you need? What do you need? I mean, you must have some minimum capital, isn't it? Yeah. You must have, in this case here, a healthy balance sheet, a healthy profit and loss account, and not for 1 year like the last 5 years. Corporate governance. You must be a company that is directed and controlled very well. So you have a board, etc. etc. So minimum paid up capital. A company must meet a minimum paid up capital requirement to be eligible for listing and offering shares to the public. Track record of operations. The company must have a proven track record of operations, typically for a minimum number of years, e.g. 3 to 5 years. In Kenya, it's 5 years. This demonstrates its business viability and stability. Audited financial statements, you must come, in this case here, you must come to our company. You must come to our auditing firm. I don't know whether you guys are aware that I run one of the, efficient great audit firms in Kenya, Aura and Company. We are based at Westlands, Havens Court. If you come at Havens Court, first floor, you'll be able to get Aura and Company there. So many, if you want to list, you must get services of a registered auditor who will be able to look at your books, and then they do what year? They certify. They give an opinion as to whether your financial statements are portraying a true stroke fair view. So if you don't have audited reports, then nobody will be able to trust what you're telling them. So you need what we call an independent examination of those transactions, financial transactions. Yeah, public shareholding. You cannot tell us that you want to go public and yet you want to hold all the shares yourselves. You must bring the public. You must bring other people. You must be willing to offer shares out there. So public shareholding requirement, a certain percentage of shares must be held by the public. Usually a minimum percentage like 25%, ensuring that the shares are sufficiently distributed among investors. We shall not have one investor having like 50% shares, no. Then we have here good corporate governance. Good corporate governance, the company must adhere to corporate governance standards, including having independent board of directors to ensure proper oversight and accountability. I thought that was the last question. Oi, there are still others. No, one more question. But I hope you guys are following. Are you following what I'm discussing really? Are you guys understanding what I'm discussing? Are you guys able to understand what I'm discussing? Yeah, free transferability of shares, that's very, very good. Yeah, administrator, we have advertised for audit senior job, lakini you need to be a CPA, so I don't know. You need to be a CPA. You need to be a CPA over there for audit senior. If you have somebody who is working especially for these mid-level audit firms, tier 2, bring them. I'm so sure after the big four, our salaries, of course, are not bad. Our salaries, not big four quite high, but we have like Ronald's, you have you know them, those farms, TMK, you know them, good farms, graduate trainee program. Oh, okay. Great. Fine. I'll be able to send Caroline. Caroline wants somebody can even assist me. Yeah, where should one raise a complaint? Yeah, you can even raise it here or to my personal number. That's my personal number. Yeah, financial ninjas, yes. Yes. Yeah, they're found. You'll be able to see. We shall overcome. Let's talk about that when we finish now this question. When we finish this question, April 2023, question number 4A. April 2023, question number 4A. Distinguish between the following terms as used in financial institutions and markets. We have this intermediation and intermediation. Very easy. So intermediation is where we have A, B, and then we have a bank in between. A is a rich man, does not have what to do with his money. So what does he do? He takes this money to the bank. And then we have B, who has got many ideas than the money he has. So he needs a loan. So he goes to the bank to borrow. So that's what we call financial intermediary, in between, a bank coming in between. But now when it's this intermediation, now we don't have a bank. Now we have, in this case here, B approaching A directly. Like, for example, when Safaricom wants to borrow, Safaricom does not have to go through any bank. Safaricom can issue their bonds directly in the market. So they are practicing what we call disintermediation. Disintermediation. All right. So if I come, ladies and gentlemen, and share this. So intermediation This refers to the process where financial institutions such as banks act as intermediaries between savers and borrowers. Banks collect deposits and lend the money to borrowers, earning a spread between the deposit and loan interest rates. And then we have disintermediation. This refers to the process where investors bypass traditional financial institutions and directly invest in markets or other investment vehicles such as bonds or stocks. This reduces the role of intermediaries like banks in financial transactions. And then we have call markets, continuous markets. There is a time when Nairobi Stock Exchange was a call market. And today it's a continuous market. So continuous market means what here, that our shares at NSC are selling throughout. Now we have automated trading systems. Actually, now with even online, you can buy shares at night. You can buy shares anywhere. All right. That's continuous market. In those old days, what used to happen? You are being told, do you want to sell your Safaricom shares? Yes, give us your share certificate. They lump them together. And then in the evening, now they'll call people, not even evening, at around 2 p.m. They used to call now people, we have got these shares, come and buy. So that's calling, you call people, come and buy. So you agree on one price, which in this case will be used for one particular counter. In this case here, at the same time, so all those shares are bought at the same price. You call them. All right. So when you look at this intermediation here, I don't know, call markets versus continuous markets. So we have here call markets. A call market is a market where trading happens at specific times. All buy and sell orders are collected and executed at a single price, typically at the end of the trading session. Those are call markets. Continuous markets. In continuous markets, trading happens throughout the day, with prices changing constantly as buy and sell orders are matched in real time. Examples include stock exchanges where trading happens at any time during what year market hours. So if somebody, ladies and gentlemen, tells you to differentiate between call markets and these continuous markets, I mean, two words. What is the difference between those two terminologies? Continuous markets and call markets. So under call markets, what is happening? In your own language, continuous markets, what is happening? In your own words, it's about time. So continuous means all the time. Yeah. I can see because trading is happening all the time and are continuous. So, it's demand supply. So the prices will be constantly changing. The call is at a specified time, while continuous is at any time. Continuous, the price is fluctuating. Thank you so much. Great. So I finished in this case now laying the basis for my topic. Now we start doing this from the beginning. So please, now we are reading this handout. Now everything will be very okay. Because now at least now you have an idea. You have an idea of what I'm talking about. Yeah, for those of you, of course, who would want to make inquiries, this RCM college is the best college in East Africa. And these are our contacts: 0793 555 000, 0793 555 000, or this one here. And the paper is known as financial management. So you can now see these notes, ladies and gentlemen, they have everything like risks facing financial institutions, credit risk, market risk, liquidity risk, operational risk, those things. You can see like now here 3.9 factors responsible for the rapid development of financial institutions and markets. Ladies and gentlemen, why do you think in this case here we have so many banks growing actually haphazardly? Like now if you go to Rongai, you'll get like all the banks now have branches there. Absa Bank is not a Kenyan bank. Stanchart is not a Kenyan bank, and yet they're coming to Kenya crazily. What are some of those factors that are enabling expansion of these banks so rapidly? Are you able to give me your own points? I'll give you 1 point: globalization. That now the world is becoming a single globe. Yeah. So I would want in this case here a bank that is in Ghana. Like my bank, when I went to Zanzibar the other day, I found a branch of my bank there and I was so happy, Stanbic. Yeah. And even to test, I was able to go and withdraw something out of it. Yeah. So because of this globalization, these consumers who are moving up and about, they are putting pressures on these banks. Yeah, technological advancement, I like that. Available markets, yes. Technological advancement, business security of the country, competition on interest rates, yes. Favorable government policies, yes. That I will give you. Favorable government policies. Oh, with M-Pesa, oh, okay. Ease of regulations governing governments governing opening up branches. Yeah, ease of regulations. Yes, ease of regulations. Yeah, you have actually given me very good points. Please listen. So we have the economic growth. Ladies and gentlemen, I saw somebody who was speaking about Kasongo. Kasongo has done what and what, whether you like it or not. They may not be the very best government, but our economy is growing. I'm seeing so many people in this case here with crazy money out here. And they're young men that I've just taught here the other day. All right. So with the economy growing, then we expect, of course, people to put money in banks. Technological advancements, I can see that. Regulatory reforms, effective regulation fosters investor confidence and market development. Financial inclusion, efforts to provide financial services to previously undeserved populations. Drive growth in financial markets, like what Equity Bank did. Globalization, increased international trade and investment leads to expansion of global financial markets. Thank you. I'm reading upwards, no problem. So, like if you go to page number 10 from your syllabus, they want us to give them regulation of financial markets. What is the role of the Central Bank of Kenya in regulating banks? What is the role of Central Bank of Kenya? You can see CBK oversees monetary policy, manages inflation, and ensures the stability of the financial system. Like during Uhuru's time, yeah, Uhuru, great president, right? But remember, he was coming, taking us through COVID. I mean, so things were really thick. Things were very thick. So because of that, food prices went up, and that is the time when, I mean, so many things were not happening well globally. So the inflation was very high. So when Ruto took over, of course, things had started becoming a little bit better. And then he knew exactly how to fight inflation. To fight inflation, of course, he has been assisted by rain. We have had rain. Remember during Uhuru's time, we had, rain failure for 4 years. All right. So inflation, of course, has been taken down so nicely because of what here? Good amounts of rainfall. These people pray. Nice. But one of the things that central bank did, which really worked for us, they raised interest rates. When they raised interest rates, what happened? Then the banks, in this case here, went ahead and gave government money. So they were able to mop excess liquidity from the market. Yeah. Yeah. So inflation went down. That is the concept of what here? That is the concept of doing what here? That is the concept of monetary policy, reducing inflation. All right. Reducing inflation. All right. And many what here? Many things. So whenever you hear of CBK, you must remember that concept of what here? The macroeconomic factors. Like now they did something. The audio. Oh, this audio of mine today. I hope now is very good now. So we shall overcome. We shall overcome. We shall overcome. Great, 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 great. So whenever you hear of CBK, and this is very popular in your exam, you must be able to remember some of those things. You must be able to remember some of those great things. I spare 10 minutes, approach the financial management paper. Yes, yes. All right. Then we have our famous Capital Markets Authority. Remember, Capital Markets Authority is the one that regulates NSE, Nairobi Securities Exchange. So regulates securities market, ensures fair and transparent trading. Then we have Insurance Regulatory Authority, oversees the insurance industry to protect policyholders and ensure what we call solvency, IRA. Ladies and gentlemen, do you guys have insurance policies, especially medical? Especially medical? Do you have them? Do you have insurance policies? I buy them. I buy them. Yeah, please, you shall never. No, 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 no. Private. You shall always buy private. Like mine here, you can see for this year, you shall always buy private. Like this one here is for AAR. Yeah. You can see for my family. Yeah. About 800,000 like that. It is the best. It is the best. It is the best. It is the best. Under AAR. Yeah. You get like a 40 million cover. It is, and remember, I still have what year? One from my employer. All right. Because I also work somewhere. Yeah. Yeah. Because one thing that I know, you are normally one sickness away from poverty. I've always told you that. Doesn't matter the kind of job you are doing, but you are just one sickness away from poverty. Is there somebody who has ever experienced very serious cash outflows because of some disease? Yeah, yeah, yeah. So if you can afford, for example, like I have a family of how many people now? 5 people. Yeah. That 800 a year, it's like 80,000 a month. You may think it's costly. You may think it's costly. But what I have seen, like there is a time I told you from Christmas, I spent with my son at Aga Khan. I mean, the bill that we paid over there, were it not for this kind of insurance companies, I would have come for you to help me. But you see over there now, once you have this kind of covers, and then of course you must, if possible, like now my employer's cover is the international one. It's very good. It's very good. So you simply go there, ask in this case here for the best bed. So tell them you want that bed of 43,000 a night. All right. Yeah. So you're treated like a king simply because of what you insure? Insurance. Yeah. Insurance. Yeah. Like Cigna for life. Yes. I use AAR. AAR is good. AAR is good. But I always like I've seen somebody here talking about Jubilee. Jubilee is equally a good insurance. It's equally a good insurance. And remember, you are, oh, no, 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 no. Now look at this ninja called Judy. I started my life cover at 50 year and they literally robbed me. You see, Judy, not unless it was because of a loss of a job. Whenever you have a life cover, you should always endeavor to finish it. You know, this concept of insurance is not well taught to us. You see, you are doing like for a child educational insurance, right? And you're paying like 5 million. You're paying like 5 million. Then somebody will come and tell you that if you continue paying these, the money that you'll get at the end of the day will be much less than even what you have contributed. Even if I was to get exactly what I've contributed in a life cover, I will still invest in a life cover. Do you know why? I mean, Judy, you are looking at the risk. Should you die? Should you become disabled? And you see, over 15 years, we have to look at life very, very positively. 15 years is a long time. Something can happen in between. And if it happens, and I've seen that happening severally, if it happens like this, those guys will be able to now take care of your premiums, and then they pay your next of what year? Next of kin. They pay your next of kin. So don't go for a life cover thinking that, no, I've always seen, because I always do these talks to so many people, but I'm not an agent. I'm not an agent, insurance agent, but I know there are people who make mistakes. Somebody gets into a life cover and then they think like, I mean, what if I was putting this money, and they start doing those calculations at that 50 year? That's when most of them start. If you go and now request back your money, they'll tell you like 50% of this money has gone to the agent. So if you have contributed like 500,000, they may even take 300,000, and it's because of how insurance works. So if I were you, Judy, I would even go back to them, discuss with them. I mean, I would want to continue with this thing. They slap you some little penalty, and then you continue with it until the 15th year, because you are covering your child. Should you die, should you become disabled, it is the cover you are buying. I wish I had time. I can talk about insurance as a way of you guys minimizing your risks the whole day, because many people don't know these insurance things. Yeah, try to revive it. Yeah, Tabitha, I mean, it's good. You don't look at the return. There's nothing like return under education policy. You're buying that cover. It's called a derivative. You're buying the cover itself. Should I be disabled today? Should I? But now there is somebody who told me that if, for example, you have, people are crazy. But if you have, for example, an accident cover of 20 million, all right? Yeah, a life policy of 20 million, and you're a man, please go and put that policy in a bank, like a safe, like how we put our certificates. And then I asked this guy why, and he was speaking like the way I'm speaking now here, so silently, that if your wife in this case here got that kind of insurance, and she knows that if you die, she can get like 20, 30 million, and she'll start feeding you steel wire. I don't know what steel wool does to our stomachs. I don't know. I mean, that's bad language. That's bad language. I mean, do you want to tell me that your wife would be happy when you are dead? I doubt. I doubt. I doubt. I doubt. I doubt. Okay. Those are misinformations, yes. Misconceptions, yes. Oh, Jubilee not good in medical cover, old mutual all the way. Oh, okay. Wow, okay. Yeah, we have talked about insurance. We've talked about Osara is an agent. Oh, great. It's good to have so many agents. But again, most agents really, they don't know how to sell insurance in Kenya. I wish I was an agent. I can really sell insurance because I know I've benefited out of insurance, and I know I know how they are good. I know how they are good. But most of these insurance people, they don't know how to sell it. They need to come for classes. All right, ladies and gentlemen, I think we have covered more than enough for the class. Now we can talk about general life and investments. So you can now continue with this class tomorrow evening. No, I know you have a class tomorrow evening, isn't it? And I'm the one standing in for Teacher David today and tomorrow. So because I promised to take you through this concept of investments for about an hour, I can see I only have 30 minutes. Or tomorrow is FR, okay. The other class will be on which day? Ni kunyonga kuku. Not some, all women are very good. It depends on how you treat them. All women, perfect. I mean, they're our sisters, they're our mothers. Already sell more than men. MMF, okay. Great. Or Friday, 8 p.m. Friday, 8 p.m. I have AFM. Yeah. But I hope the students who are guests here, these students here, are they going to join Mwalimu here for this financial management? Are they going to join RCM College? Our number is 0793 555 000. 0793 555 000. Yeah, you need somebody who will be able, at times you get somebody who clears financial management, they clear advanced financial management, and yet they can't advise anybody on financial matters. That's very, very sad. When you come through my class, on top of you becoming prudent financial investors, you guys are going to become very good financial advisors. Financial advisors. So our number is 0793 555 000. Yeah, you need to join this particular class. All right. All right. Remember my question about the days. Which days are that? Vero, these questions are very many. They are very many. We shall overcome. So are we ready for low income earner? So are we ready for our talk now? Now I need to stop anything to do with financial management. We talk about how do we save and how do we invest, those two things. Kenya for passing FM, that we can take it to another day. All right, great. So then I don't think my students